What's up, everybody? This is Chris Noggle, your host, and welcome back to the show. Today is going to be epic, and we're going to be talking about being the bank, but not in the normal way that I talk about being the bank. You're going to learn that being the bank can be a lot of different things, and I've got two extra special guests. I've got Nick Legamaro, which I always think that I'm screwing the names up, but I nailed it. And then I got Eric Sage, or Sage, if you really want to get technical. So they're going to be talking about some really cool stuff. Nick is known as Nick, the note guy, and Eric is just Eric. But before we get into their topic and everything else, I want to talk about all of you. I want to talk about your journey to becoming a rebel banker. And that journey begins with knowledge. And you've heard this a lot. You've heard that knowledge is power. Bullshit. The person that told you knowledge is power lied to you. It's not the knowledge that's the power, folks. It is the application of the knowledge. If you don't apply knowledge, you're going nowhere except for thinking you know something you don't know. So, folks, today in this episode, I'm going to challenge you to take action and actually use what you learn here. And I'm going to actually test your knowledge by giving you something for free. I just came up with a new book. Okay. This book is called Drifting Away from Traditional Car Buying: How to Keep Your Car and Your Finances in the Fast Lane. Essentially, it's a book that talks about how to get all the money back for all the cars you're ever going to buy, drive, and own. That's not really an important topic, but if you want that book for free, all you need to do is go to chrisnoggle.com and then sign up for the free wealth webinar, and we will send you the book. Simple, right? But that right there is how you take action. Simple action leads to massive results. So let's get into this. Eric and Nick, welcome to the show.
Hey, Chris. Thanks for having us.
Hey, Chris. Great to be on the show.
Absolutely. We were talking about all sorts of things before we started, from monsoons to how much we love and hate pools, to our children and how sometimes we just want to kick them out of the house or keep them in the house, and travel and all sorts of stuff. But now we're going to talk about some really fun things, and that's being the bank. But before we get into that, can you just give a little background of what you both do, what your business is, and this whole be the bank and the note guy? Like, explain that a little bit.
Yeah. So I've been in real estate since early 2000. So I've lived through what, if you want to call it the crash or whatever, of 07 through 09. And here I am living and tell about it and survive. But it was ugly, to say the least. But, where we are today and where we could be heading is of zero concern or fear to me now, because it's only the fear of the unknown. And now I know, and I'm prepared. And I think Eric would say the same. But after we came out of that crash in 09, 010, I started another real estate company, and it was called Rylex Capital. And I started with my partner at the time was, and many listeners may know who he is, John Montero, who now is big in the multifamily space. So John and I put this company together. We built it to sell. And that's eventually what we did. We built this note business. We built this be the bank business we're going to talk about here today, with creative deal structuring, specifically on creating notes and primarily selling on terms to owner finance buyers. And we turned around and eventually sold that business to a bank of all people, or all entities, in 2018. And from there, really began, partnering with Eric on really how to educate people on how to be the bank, because a lot of people don't know what being the bank means. And we'll talk about that today. And more importantly, they don't know that they can be the bank and even know how to do it, and how they can even write notes, create notes, buy notes, invest in notes, and really have the mentality of being a lien lord, not a landlord. That's what I like to call it. And it's all about, in my space, it's all about control, not owning. And there's a reason why most banks are the biggest buildings in most downtowns. And they've learned a long time ago that on how to basically, control versus own. And that's what we're going to talk about today.
Well, the Rockefellers talk a lot about that. And they said, you want to own nothing but control everything. And that's exactly what we're going to get into today. But you missed some things there. You've been a lender on thousands of properties. You've, done the buy, fix, and flip. Oh God, that my hair just stood up on my arms.
Mine too.
Anyway, you've done rentals, you've built companies and sold them off to chartered banks, and you've what review? You've looked at like 10,000. Is that what I'm reading here? 10,000 deals.
You know what? It probably is more. Honestly, I lose count of all this stuff. I stopped counting on how many notes I've created and transactions I've done. All I know it's a lot, and I don't really care what it is anymore. I can't remember what my birth date is, let alone anything else.
So you've done a lot of stuff. Now, Eric, let's talk a little bit about, what you do. Now, I know that you're a professional at filling in pools, but what else is it that you do?
Well, first of all, I want to say, because you were a skateboarder, right?
I was a pro snowboarder, and then I still skateboard a lot today.
So today, I'm supposed to be at a baseball tournament with my son, but he decided last week to not learn how, but to go up to a higher level and do some drop-ins off a half pipe, and broke his arm. So he's not playing baseball for a couple of weeks. So that's awesome. Oh,
they can cast him up and he can swing the baseball, put him out in the outfield and just catch it with the other hand.
That's what I said.
Excuses.
I'm like, can you at least, because it is your left hand, so can you at least catch it? Because they have you starting pitching. He's like, no, Dad, I can't.
Does anybody remember Jim Abbott from Michigan and,
yes.
and the one-handed baseball picture? Are you kidding me?
Oh my God. Yeah, there you go.
That would have been awesome,
man.
So anyway, I'll give you guys a little brief background. I've been buying and selling houses since 2004. I've like Nick, I've done probably over 1,000 transactions, fix and flip, buy and hold, land splits, lease options, everything you can think of. I've had large teams, I've had small teams. And several years ago, I called one of my hard money lenders, because about fix and flipping houses, you want to always, you want to borrow money, get some leverage. And I called one of my private lenders, and it's not a hard money lender, because I always create lenders, because people are sick and tired of putting their money either in the stock market or in a bank account earning less than 1%.
Eric, let me stop you there. Okay. I wish you were right about people not, getting nervous about putting money in the stock market. What I see right now is a whole bunch of sheep following the herd right off the cliff by dumping money in the stock market. That's all you ever hear about. Like they're just piling money in the stock market, and they have no idea what they're doing. I didn't mean to cut you off, but man, like people need to wake up right now.
Zero control when it goes back to what we're talking about. So I called my lender, and I said, hey, what's your debits and credits of your lending company? And he goes, well, I just have credits. And then the only debits that go out are when I lend you money or other people that I know money. I said, so you don't pay taxes, insurance, maintenance, repairs, none of that BS that all those 6 or 7 different expenses go on being a owner of property. And he says, no. And I was being sarcastic. I said, okay, I'm switching. As of today, I'm putting my foot down, and I'm going to go heavy into the lending side, but not on your side. I'm going to do it in a way that actually makes me feel good and know that there's opportunities to help people they're non-bankable, but they're phenomenal borrowers, right? And so that's what I ended up doing. I have a real estate business, so I'm constantly, I have opportunities to do deals. So my main focus now is I buy and create paper, and I work with non-bankable borrowers that are non-bankable people that are unable to get bank loans, but that are phenomenal borrowers. And then I build my wealth by buying and partnering on apartment buildings. That's kind of my business right now. And so the one thing I love about your model, and this is what I'd love to kind of get into it a little bit, is when we buy a house and we create the structure properly, when we buy the house and then we resell it to somebody that can't that's not bankable, which Nick and we go over this all the time, where if you go and actually look for seller finance houses on the MLS, if you're familiar with the multiple listing service, or even call any agent in the world and say, pull up every house in your market that's for sale that the seller wants to be the bank, something like that. And there's the percentages are so skewed, it's not even close, right? But if you know how to structure those deals in your favor, I mean, with your model, with what you teach and train your customers, it's just a no-brainer. And so the cool thing about this is, like I have a portfolio of about 100 notes right now. And those notes, I have one assistant. I pay her $1,500 a month, and she handles the whole thing. I really don't do much. And then I just keep creating. So that's a little bit of background about what I'm up to.
Well, I like that. Creating paper. We're gonna really get into this topic of creating paper and what that means. Because for some of you listening, you might think what Eric's talking about with creating paper is he's actually going out chopping trees down and running a paper mill. That's not what he's doing. He's actually being the bank and mimicking exactly what the bank does every day, but he's getting paid for it, and he's not working any harder, not working any longer, taking on very little risk, but he's in control of everything he's doing. Now, doesn't that sound sexy? Well, it is.
Well, you know what? Hey, you know what? It is to us, Chris, but I tell you what, you're not going to see it on HGTV or Fix and Flop That or, zombie property, whatever, because it's just hard to make that done. But I do want to throw out a couple. I'm sort of a stat nerd, and I think these are some pretty compelling numbers. Number one, let's talk about the size of the seller financing industry. Okay. And what I mean by that is how much paper is written annually by individuals, companies that aren't named Chase, Wells Fargo, Bank of America, the non-traditional lenders. And that number is about $25 billion a year. That's billion with the B. Okay. That's a lot of mom and pops or small lenders that are not traditional lenders. That's a fairly significant number, at least in my space. So that's one. And then the other critical number of this whole thing is, and Eric alluded to it a little bit when he was speaking earlier, is that the percentage of borrowers or buyers that want to be buyers that want to have home ownership that can actually get one of those traditional loans. Look, interest rates are historically low right now. We know that, but that doesn't mean you can go down to the bank and get a mortgage. It's actually very, very difficult to do so. And it's probably about 65 to 70% of the population today cannot do that. For example, I cannot go down to the bank and get a traditional loan because I own multiple companies. I get distributions. I'm not a pretty borrower in the eyes of the bank. Doesn't mean I'm not a good borrower. I could have 10 times the money in the bank from a cash perspective to go buy it. They still don't want to lend to me.
Absolutely.
It's
right.
ridiculous. Let's hit the way that it is.
Let's just hit on that for a quick second, because the listeners need to know what that means. So, you're incredibly successful, and I'll throw myself, and I'm sure Eric is, but none of us are probably bankable. I just bought a new house for my family, and I walked into the bank thinking, I make lots of money. I'm not going to put any zeros, but more than enough. And they look at it. And when I was going to this regular traditional bank, they said, you know what, we're going to have to take you to one of these specialized lenders that deal with people in your situation. I'm like, in my situation, like something wrong? Well, no, nothing's wrong. You show a bunch and you've given us all your bank statements, but the problem is you don't have enough W-2 income. I'm like, yeah, no shit. I don't want to pay taxes on all the freaking money. Like you guys, like you pay tax on every penny you make. I run it through a company and I get a 1099. And they're like, yeah, I know, but the banks don't love 1099. So we're going to run you through these special lenders. And when they came back, I'm like, all right, well, they got me approved. 8%. I'm like, I'm not even going to say it, but are you out of your mind? So I went to a community bank and got it done. But like, come on, man, how is it that with the income, yes, we're 1099, maybe a little W-2, but how is it that we can't get finance through a bank? There's something wrong out there, and I don't quite know what it is, but
they got their hand. Guess what? It's just going to get worse.
Yeah,
it's already getting worse.
Understand
that's why we're talking about this today. That's why we're having this conversation and where we think the opportunity is, because when that pendulum shifts and it becomes a buyer's market, not a seller's market. And the market condition is irrelevant to me. Okay. I don't want anything to crash and fail. Don't get me wrong, but it will not change the way we'll redirect maybe, but we'll be just as successful in a down economy as we will in a seller's economy. Cause what are we? We're buyers and sellers. Mm-hmm. We're on both sides of the fence either anyway. So what difference does it make? You just got to know how to play that. But
and Nick always says the greatest thing. So we have people that are tenants right now. They've been renters their whole lives. And so when we structure our notes, we're very, we're not selling houses for 30% more than market. We're not doing anything, but we're in line with a rent. And Nick always goes, what's the value of rent when you're a tenant? Zero. So even if you did get that loan that you're talking about at 8%, it's still a value to it's still a value to you, because guess what you have? You have a place to live. You have a place to pay a payment that's fixed, and you have a place to put your family for a long period of time, rather than to get displaced every 2 to 3 years. I mean, I have a family member right now that every 2 to 3 years, it's shocking to me. I don't understand it. I'm getting to the point where I'm just going to go buy him a house, because it's a hassle to move every few years. But if you have it's not about interest rate. It's about security. And that's what people are really, really want now. You know, they want that place for their kids to grow up, and now people, you know, and so when we sell our properties and we underwrite them, it's just like a Wells Fargo or Chase Bank would. That's how we structure it, because it's an owner-occupied property. And you drive by that property 6-7 months later, and they've got a new roof on it, and they've got new landscaping, and they added a guest house, and you're just like, oh my, this is just, and it's a feel good thing, not to mention a very profitable thing for all of us involved, you know, and that's what I love about it. And that's what I love about talking to you about your business.
Throw out 2 more statistics before I forget them, because I think they're important before we dive a little deeper. Number 1 statistic, and I'm putting a big asterisk on everything I say. I'm not a financial advisor. I'm not a CPA. I'm not an attorney. I'm not anything. So where the statistics come from, you can make and read them any way you want. But the last statistic that I saw, the percentage of renters that rent, about 80% of them rent because they have to, not because they want to.
Yeah.
Okay.
100%.
So 80% rent because they have to, not because they want to. And the reason why they have to is because they've been told, because they've gone down to the Chase or the Fargo or wherever they've gone and said, you don't qualify. You're not a pretty borrower. You don't check all the boxes. You don't get a loan. That's it. That's number 1. The other stat I want to throw out here, it's a little bit old, but I think it's still relevant, because it really talks to what the banks and how much control that they really have. In March of 2020, when COVID was first setting in, if you had for 100 borrowers that had already been pre-qualified, okay, for a traditional loan, okay, that they were a W-2 borrower, they worked for Amazon, they checked all the boxes, the DTI, the credit scores, the cash in the bank was there. Those same 100 people that were qualified, fast forward to August of 2020, just 4 months later, only about 65 to 70% of them would actually be able to get that same loan at that point in time, with nothing changing in their profile. Okay. So the only thing that changed was the underwriting requirements of the bank. That's the problem, is that the banks control who they want to basically lend money to. And it's, and so I'm not going to get into the rates and all that stuff, but those are numbers that are pretty, and that's not the makeup of America right now. Makeup of America are people like you and me and Eric that are self-employed. They're entrepreneurs. Mm-hmm. They're starting new business. If we learned one thing from COVID, you better have a side hustle or do something else and diversify how you're going to make your money, because you can't count on anybody but yourself to go out and get paid.
Yeah, absolutely. The cavalry's not coming anymore, folks. So
no,
you're right.
It is over.
Millennials don't want to punch a clock. You know, they want the freedom to create their own destiny, their own lives, you know, and the only thing stopping them from doing that is freaking society. Society wants them to conform, get in line, and do what they all have done in the past. And the millennials, for the first time, I think this is the first generation, followed by Gen Z, they're standing up and saying, no, I think I'm going to do my own business. I think I'm going to go my own path. And, you know, that's a hard thing, because, you know, when you look at successful people, there's only one reason they're successful, and that is creation. They created that success. They created their financial futures. The other 95%, because there's only 5% out of 100 that would make it to that level. The other 95%, why are they not where they want to be? Simple. They conformed. They conformed to other people's ideologies and other people's beliefs. And that's changing finally, but it's changing and creating a whole new dynamic of problems, which you just mentioned. Homeownership, something that millennials are absolutely now looking for. That's why we have this massive demand. They can't get the housing in most cases unless they fit in that really small, tiny little box that the banks have created, because the banks are in control. And, you know, the problem with that is we've allowed it to happen. Our whole lives, we've been taught to give up control of our money, and it has to change. And I love what you guys are doing with Be Your Own Bank. And, you know, this is something that we teach nonstop with the you know, privatized banking. But It's all about putting yourself back in control. So you're a buyer and a seller. And I want to kind of get into the mechanics because we keep talking about this be your own bank and we keep talking about, the notes and everything else, but we haven't really explained what is this. But it's very important because you can be on both sides. You can be a buyer and a seller, and you can be in control on both sides. Now that is a winning solution. So gentlemen, can you both dissect what it would mean for, let's start with a millennial that's looking to buy a house and they find one of your deals. Like, what does this whole thing look like? What are you attempting to do? And how is it solving two problems at the same time?
Eric, you want to take that?
Yeah, go ahead. Well, you go first and then I'll jump in if you miss something.
So what I'm going to work it backwards. I like sort of reverse engineering. So the whole purpose for what I like to do is I want to become the bank. I want to control versus own, and I want the note. So everything that I need to do to get that note, I have to, is a step in the process. So I don't really want to be a fix and flipper. Okay. But the fix and flipping part of it, and acquiring and fixing flipping, is the means to the end, right? By buying and fixing it, selling it on terms to a borrower that can't go to the bank, and allows me to stay in the deal long term and generate a little bit of cash now, some cash flow, and then a lump sum payout. I like that model. Okay. The benefit to the borrower, obviously, is they're going to be able to have home ownership when they've been told no. Okay. So we don't provide financing on properties that we don't own or control. That's not my model. That's somebody else might do that. We're not a lender per se. We're truly seller finance, sellers, right? We own the property and we're going to finance it. So that's piece of it. On the note side of it, there's a lot of people that you can go create your own note. We work with a lot of landlords. I think if we learned one thing, here's one thing I'll say. Banks always get paid. And not sometimes, not most of the time, they always get paid. Because why is that? Because when they provide you money for a house, they have what as collateral? They have the house as collateral, right? And unless they're stupid enough to write a loan at 125% of value, which nobody does anymore. This is
2006 and 7 ended that.
It actually can happen and did happen to me. And I'll tell you the story of what happened in a positive sense.
Well, that's because
I still got paid.
Business, right?
I still got paid. It was great.
But that happened a long time ago and you got the benefit now, and you could talk about that in a second. But the days of that are over, because what we're seeing now is what? Appraisals are historically lower than sell price, which creates a larger LTV, which protects the lender in the event of a default, right? So if you have the property as collateral and the borrower doesn't pay, then you have options to go get the property back. You may not get paid today, you may not get paid tomorrow, but you will get paid in some way. Either you'll get the loan will be brought current, or the property will be used as collateral to pay back what was owed to you. You can't say that being a landlord. Okay. If COVID has taught us anything, landlords do not always get paid. Some landlords may never get paid, and they still have a financial responsibility either to themselves as the lender or whoever the bank is. And, the eviction moratorium is coming to an end, hopefully sooner than later. But at the end of the day, there's a lot of landlords out there that didn't get paid. So, and
the best part is we're creating. I have a deal right now, and I network with a ton of fix and flippers, a ton of wholesalers, a ton of realtors that have just. And this is part of what we actually teach in our program, but how to find these deals. But I have a wholesaler that said, "Hey, this seller wants $310,000 for the $300,000 house," and I said, "Perfect, I'm the buyer. Well, it's either terms or price." So I'm going to structure a deal. Guess what? All three of those properties, guess who hasn't been paid in a year? The landlord, the owner, because then the tenants are paying. I said, perfect, I'll buy it. I'll make this deal work. It's just I structure the terms in my favor, right? I structure the payment. I know what I can resell it for. I know what my buyers are, my new buyers / borrowers are going to pay. I have the whole system in place where I'm just like, gosh, I mean, I'll do these three deals. I'll make probably 10 or 15 grand in my pocket, and I'll make $700 to $800 a month cash flow, and I'll provide home ownership to someone that's going to get displaced. And the seller is now going to get a stream of income because she's going to stay in the deal. She's an elderly lady who doesn't want to give her kids cash. She wants to give them a stream of income. So I'm going to do a 30-year payment plan for her. So guess who won there? Everybody won. She's now going to get a stream of income with no stress or headaches. I'm going to do what I need to do to get the property ready. And then I'm going to sell it to a borrower that's, that's going to be so happy and appreciative of owning a property now and a fixed payment for the next 30 years. And I just kind of stick myself in the middle, which we can go into the details, but what I was thinking about today before our call is how do we structure that with your people, your tribe. And the best part about Nick, the way he's one of the things that why we joint ventured on our education side of it and doing deals is, how do you do all that and have zero risk and a free and clear note and just keep collecting with no risk? I mean, that's the kind of the secret sauce.
You got to be able to recapitalize the business. That's always the challenge, because it doesn't matter how much cash I have. It's a bad business strategy to borrow short and lend long, right? We can agree on that. So, and that's exactly what a mortgage note is. If I write a 30-year mortgage note, I don't care if the rate is 15%. I still have to wait through that time to be able to get it. So, and if I have the velocity of capital, I need to be able to get that capital back. So that's why we don't write 15% mortgages. But what we do is that we write a 75% first lien. I write approximately a 15% second lien, and 10% comes in the form of down payment in the form of cash. Okay. So then what we do is after, let's just say it's a $200,000 loan, okay, or sale, we'll write $150,000 first. Okay. We'll get $20,000 down and have a $30,000 second. So then we take that first lien and we sell that first lien at par to a note investor that's looking for a rate of return somewhere between 7 and 10, depending on the asset and the borrower underwriting file. And then we take that say it's 150, we get back, then that covers all of our cost basis, and we wipe out our cost basis. And then what we were left with in this example is we're left with the cash now, which in this case of 20, say call it the net's 10 or 12,000 on the transactional side. And then we're left with a free and clear $30,000 note. So still secured by that same property. We're still the bank at, 10% interest. And we have zero cost basis. We have I can't even calculate the rate of return because there is no cost basis. And, we do that and we teach that, hundreds and hundreds of times a year.
And our note buyers love it because they know, this is one of the things that Nick's been a master at, is underwriting and creating a qualified buyer through the underwriting process, just like any bank would. So now they look at this file and they're like, okay, I'm going to put my $150,000 on this deal and I'm going to get $900 a month behind an amazing borrower that put money down behind us.
That's the other part of the equation. Right? So
we have the option to buy your note back at any time too. And we have the option. So we structure all these little things to protect them as well. Obviously we don't guarantee that they're going to get their money because it's a note, but look at their position, look at the borrower, and look at us. Nick can tell you every property that he's acquired and resold and created a note. Your default rates, it's next to nothing. It's
10 times less than the national average. I can tell you that, maybe 100 times less. I don't know.
And the other thing that we do is the other thing, like you were talking about what the traditional banks do. They get crushed on fees. Now they're doing this thing where you get an FHA loan and you have mortgage insurance that you can never get out of, like ever. Like you have to refinance or sell. So we have a higher rate than most, but if you back it all into the same program, it's actually less than what they would traditionally pay at a 3 or 4% loan. It's crazy.
Yeah, the closing costs on a traditional loan are outrageous. Plus, the bank's always winning in the velocity of money. So,
right.
So I want to go back real quick on the notes. So we create notes that we can obviously sell, and the best buyers for those kind of notes are people that have obviously passive money they want to deploy. IRAs, self-directed IRAs. Look, the IRA market right now, it's the retirement deposits are like $35 trillion. I think it's, again, like another 44. Number. Don't hold me to it because it depends on where you get it from. But of that $35 trillion, that's trillion with the T. I don't even know how many zeros are in a trillion, but doesn't really matter. Of that, about $10 trillion of it is self-directed. Okay. And of that 10 trillion, somewhere around $2 trillion is sitting there idle in these accounts, making squat.
Yeah.
I mean, they
self-direct. And we wrote a book 10 years ago called The $4.7 trillion Secret. Well, it's now 20 trillion. It doesn't even matter.
Yeah, just change the thing. Name. But so that's one of the buyer classes. And then we're starting to see a lot of stuff with insurance. I'm not a big knowledgeable on the insurance side, but we've entertained a couple phone calls of where they want to take these first lien notes and use it for an insurance investment, and then be able to get back out of it. So anyway, it's a very
Chris, you talk about a lot of people talk about turnkey real estate and using their insurance policies to fund those, right? So what we've done is we just added another layer without their stress of being a homeowner and dealing with all the unexpected things that happen to get your $200 or $300 a month. And so that's what I'm excited about with your tribe is adding, giving them that other opportunity of being a note holder with amortization in their favor, being the bank, right? Like we all know what the power of amortization is based on, especially with the way you structure your programs and your financial plans with your people.
Yeah. I mean,
does anybody know how the banks got away with pulling off amortization? Because oh my goodness, it's like legal loan sharking. It's bananas. I don't think people really understand, most people. And I talked to a lot of really intelligent people. And I said, do you really, really understand what amortization is and how it works? And you really do not know until you go look at the amortization schedule. Depending on what the rate is, let's say the term is 30 years, and the higher the rate, the longer it takes. But on an 8 or 9% loan, on a 30-year term, the payment will never change, right? If it's $1,000 in payment one, it's $1,000 in payment 360 for principal and interest. What changes is what portion of that payment goes towards the principal pay down and what gets kept by the lender in the form of interest. Well, it takes about 23 years for that payment to flop from being an interest dominated portion of the payment to the principal. So that means it takes 23 years for your payment to be $500 going to principal, $500 to go to interest. The payoff in 23 years on a $100,000 note, it's still some crazy number. Depending on what the rate is, it might be $70,000 still. It's bananas.
Yeah, and not many people keep houses 23 years. I mean, the banks have figured. Yeah, the banks.
That's it. That's the secret to the whole formula. I'm writing 30-year notes, but the average payoff used to be about 7.5 years. Now it's closer to 10. Go do that same exercise, run the amortization table. You tell somebody, figure out something to do, go run an amortization schedule and put $100,000 in there, $200,000, put whatever interest rate you want in it and look and see what the unpaid principal balance is in 10 years.
Well, again, back to what I was saying earlier, we've all been lied to our whole lives. We've been literally conditioned by Wall Street and the banks. And listen, I come from Wall Street, so I can speak firsthand. We've been conditioned to believe that what they say is the truth and what is the only way. So 30-year mortgage, they've trapped us right now, and they've got us, buying into this lie of, hey, the rate's only 3%. This is the lowest it's ever been. It doesn't matter if the rate was 1%, folks. It might change your monthly payment, but if you look at that amortization in the first 7 years, banks have literally spent probably millions, if not billions of dollars to figure this out. People move or refinance their mortgages every 5 to 7 years. So statistically, the first 5 to 7 years of your mortgage, and don't take my word for it, look at your mortgage statement, look at your payment. 80 to 85% of every dollar you pay to the bank is going to interest in the first 7 years. And then what they've done is they've trapped you. Once you start actually flipping that, where it's like 75%, is only going to the bank. Bank's like, ooh, we gotta hook them again. So then the mortgage broker calls you. They're like, hey, we got this great deal. Let's get your payment lower and refinance you. And you just start the clock over again. The mortgage broker gets their commission. You get screwed in the beep. You know what I'm talking about. out. Like, it's stupid, but
So Chris,
everybody's buying into
here's
the
the
lie.
100,000. So Chris, $100,000 question is, that sounds really horrible if you're the borrower. Would you agree?
Yeah, but it sounds great if you're the lender.
It sounds great if you're the bank. And that's exactly what we're talking about here on being the bank.
Right.
So use it to your, if there's nothing illegal about it, use it to your advantage. I just ran $100,000 amortization, 10-year payoff on $100,000. The payment on that at 5%. So it's a fairly low rate. Okay. 5%, the P&I payment, principal and interest, $536. Okay. So 536 times 120 is probably going to be what, about 60 something $1,000 in interest. But the payoff to the bank, who's the bank? I'm the bank. You're the bank. Whoever wants to be the bank, in 120 months, the payoff, even at 5%, which is extremely low on a seller carry note, is still $81,000. $81,000. There's your lump sum payout at the end of the day. So I'm telling you, it's securitized. I mean, I think that you're telling me I'm going to get all the benefit and I'm going to get all this return. My investment is still protected by the damn property that's probably gone up in value. Are you kidding me?
And think about now with all these banks giving you a 3% 30-year fixed mortgage, and you're trained to go control that debt forever. They hate what we're going to be doing because we're training people to control that debt and actually help a seller. Like I tell all my people that have 30-year fixed mortgages, never ever pay off that debt, because inflation's the reality is inflation's coming. And if you can control debt at 3%, Warren Buffett said it 10 years ago when all the hedge funds came in and started buying up all the rental properties. He said, if you can control debt at 5% for 30 years, buy as much buy as many properties as you can possibly do. And that's what these guys are doing. And then they're securitizing it anyway. You can go into a rabbit hole on that.
Anyway, hope we didn't get off on a tangent on that, but
I know. No, and you had mentioned, it's like, where does all the money come from to fund these deals? It's so easy. You mentioned self-directed IRAs. You dabbled on the insurance, specifically the business we're in is the privatized banking business, which is specially designed and engineered whole lives. There is probably, I don't know the number, but billions, if not trillions of dollars sitting in cash value. And most of these people outside of our clients, because they are trained by us to move their money like a bank moves it through the infinite banking concept. But most people don't know anything about how to move money. They just put it there and leave it sit, because we've all been also taught to be the only people on this planet that believe in like giving up control of our money and just leaving our money sit somewhere. Mm-hmm. There's not a business in the world that does that. No banks leave money and just leave it sit. Car dealerships certainly don't. Grocery stores, my God, the peas on the shelf, how long do they sit there? Not very long, because they're moving their money in the form of inventory. We're the only ones that have been taught and lied to about that aspect.
Yeah, and the funny thing about that is that the banks are the epitome of do as I say, not as I do.
Well, we've got this little game we play, and Bank of America is usually the target. We have people go into the bank and we have them say, hey, listen, they're sitting down with their person that wanted to meet with them to get more control of more of their money. And I tell people, go in and ask the bank. They tell them you want to invest all your money, but I want to put my money the same place the bank puts their money. Can you do that? The answer is no. The bank will flat out tell you, I'm sorry, we can't do that. So, but wait, you can't put my money the same place that this bank puts their money? Nope.
Well, go ask them this question. Hey, I'm going to put in $100,000 into your bank, but I want $1 million worth of lending power or borrowing power, because that's what the banks get. Mm-hmm. Or whatever it is, 9 or 10
100%. Yeah, it's
deposits, whatever.
Yeah, I think it's 10 times now.
10 times or whatever it is.
Yeah, it's insane.
Yeah. So it's not a fair game.
No, it's not. And it never will be until people get smart enough to realize that they can be the bank. They can take control back themselves. But, too many people say, oh, that sounds too good to be true, and they move on. Well, that's not what you guys are teaching.
Hopefully to give them a little bit of insight and just go ask questions and just go look and see and figure out how they can do it. And just, you don't have to go create the note. You can surely go find one and make sure you do the due diligence and accomplish the same thing. And
that's what Nick and I, because we have a plethora. The greatest thing about The example I just gave you today of I have 3 deals that the seller wants 10,000 over market value. So how many wholesalers can wholesale that property?
0.
0. How many agents can sell that property?
Probably
0.
very few.
How many of those do you think I can buy, Chris? Every single one.
and so then I go and it's the craziest thing because these wholesalers know exactly what I do. They actually know even who my buyers are. In my market, I'm kind of lazy. I have one realtor that has all the buyers that can't get a bank loan. Just it doesn't take. We were just talking about our pool company and how no one's working and whatever. Well, those are buyers and they're great borrowers, man. They work hard. They pay their bills and they're good people, but they're not going to go to Bank of America. So I have one guy that I go to, Frank. He's awesome. And he just literally will go, his agents will run over there and do a FaceTime or they'll do a Facebook Live and he'll have as soon as I tell him the houses are sold, sight unseen, and these people have good down payment money, and then we obviously go through the process, and get them underwritten because they're qualified borrowers, and so I always like to do compare and contrast sometimes in regards to like your clients, right? The insurance side, and they do, and I've talked to a lot of people, and they do the turnkey rental model, and they pull their money out, and they get leverage. You can do the same thing with this, but just be the bank. You double your cash flow. I mean, you literally double your cash flow and have
here's what I'll say to that also, to add on that, is that I think people don't realize sort of the fear of the unknown, right? If you don't know, you fear it or you say no, right? But because you could be people that are listening, I'm sure you got people that do fix and flips that are listening in, or wholesalers. Well, here's a fun little test when you have nothing to do. Go take a property, go post it on Facebook Marketplace, make sure you own it, and say, property for sale with owner financing with, approved down payment.
I put for large payment. I put large down payment for qualified buyer. I make it general because
my point
large might be 3,000 for some people, but might be 50,000 for somebody else. I mean, Nick, we talk about all the time because we didn't understand that there are people with that much cash. And so we just let them tell us what the down payment will be, and then we back into it. So, and it just secures our investment better.
But yeah, it gives you better LTV or investment of value. But what I'm saying, the point that I'm trying to make is that the number of buyers that desperately are looking for home ownership are willing to pay even a higher interest rate and still keep it qualified is way more than most people can imagine. And the only way you're going to know that, besides believing what I'm telling you, is to go out and do it. And it's a crazy thing. And if you're a landlord and you're tired of screwing around with tenants and toilets and not getting paid, just take one and turn that property into an owner finance deal. If you already got debt on it, leave the debt there and wrap the debt. If you don't have debt on it, maybe you refinance out and get long-term. I don't really care.
You'd be surprised that your tenant probably has the money in their mattress right now.
They might have it, but regardless if they do or they don't, maybe they're gone, and you come in and say, I'm not going to put another tenant in. I'm going to put an owner occupant in, because the return on it is going to be every bit as good, if not better. Now, granted, you're not going to get depreciation. I get it. But depreciation doesn't last forever anyway. Okay. And you got to have enough to offset the depreciation. And number two is, I go back to the bank mentality. Okay. Banks are very greedy. Let's be honest, right? If depreciation was that damn good, the bank would figure out how to get depreciation too. Right?
I agree.
And the last time I checked, all the banks are the biggest, baddest in town. And if you can emulate what a bank does, that's probably good enough for most investors. Not all investors, but for most. And I'm in that category. It's good enough for me.
Now, I think a lot of people with this stuff that we're talking about, and I know we've answered this, but people sometimes are just a bit thick-headed. Like I talked earlier about the sheep running off the cliff. I think they think when we talk about being the bank and doing these notes and creating the notes and all this stuff, they're like, oh, well, I got to have a lot of money, so I can't do this, because people just don't realize it's not about your actual resources. It's about how resourceful you can be. So how much money would someone need to do what you're doing, learn from you, and actually get off the ground and do it? I mean, is it $100,000, $200,000, $1 million?
Well, it's all about velocity of capital, right? So you want to be able to get in and get out and repeat. And obviously the bigger stack of capital you have, the easier it is to do that. But most of the stuff that we do, let's just say, I'm just going to use a round number. Let's say it costs $30,000 to control the acquisition, the disposition, and creating the note and exiting out of that. So that $30,000 of physically hard cash has to come from someplace. It may come from your bank account. You may borrow it along with the hard money, whatever. So obviously, if you have some liquidity and have some ability to invest, it's gonna speed up the process. But like for the stuff that I do, that I actually create, I create the opportunity to create the deal. Right now, I put about $5,000 into all my deals that I take down, because that's the requirement when I buy from a wholesaler. That's what I have to pay. That's the deposit. With the way my lending is set up with my lender, I get all that money back at closing when I close on it. Okay. So I get all my $5,000 back. Number two, my rehab is borrowed. Now, granted, I'm paying for this money. Okay. It's just a cost of doing business. But when you model it out, it doesn't matter, because it's still a profitable model, and I have infinite ability to do as many deals as possible. Number two, the way I have it set up now, I've done hundreds and hundreds of these deals, and it may take somebody a little bit of time to be able to get to a level similar to this. I don't make any interest payments. I get 6 months on the money that I borrow before I make interest payment number one. So what does that allow me to do? It allows me to do infinite deals if I choose to, right? Because I don't have to make a payment. I've done hundreds and hundreds of deals. I've never made one payment, because why? I'm not in these deals 6 months. I'm in and out of these deals in 45 to 60 days, maybe 90 if it's a heavier rehab. So I'm getting to leverage all that. I'm getting to leverage other people's money at a cost. And look, even if my capital costs me 15%, it's way better than using my own money. Mm-hmm. That's it. That's my position. People that have cash and use cash to do transactions, they use it because they don't have an alternative to do something else. In my opinion, they don't have a better investment opportunity than investing in that deal, or they're just afraid to borrow and be responsible to somebody else. Those are really the two reasons that I see.
Yeah. Now, Nick and I just went through this model, because we've been doing this for ourselves for a long, long time. Right. And so we're like, we got to share this with more people. People are asking us if we can help them. And so we're creating our little deal. But we went through this model of like, is rehabbing that house for $30,000 better than lowering the price and selling it in 3 to 4 weeks versus 90 days? And then letting our borrowers, because I know when I bought my first house, it was in 2002 or 2003, whatever. Like, it wasn't a nice house. It was okay. It was, and I didn't do, I put my own sweat equity into it. Well, people are more willing, especially people that can't get bank financing, are way more able to put sweat equity in. And the labor is one of the most expensive part of renovating a house, especially a first-time home buyer house, the houses we're doing, although this works for $1 million homes too. But the point is we're like, well, why now, when it's a seller's market, do nothing to the property, just lower the price, rinse and repeat, quicker. Now
let me ask a question to Chris here. Chris, are you ever fix and flip the house? I know it's a sort of rhetorical question.
267 of them.
So have you always been under budget on every one of those houses?
No, I think over on every one.
And have you always got it? You've always did the remodeling and finished it much quicker than you forecasted, correct?
Never.
I
hate rehab, and I hate dealing with contractors. I hate dealing with building inspectors. I hate dealing with property, like all of that crap. I can't. The only reason why I can tolerate it is because it's the means to the end that I talked about, and I'm going to build. It's not a job, because I'm creating cash flow, and a lump sum payout that I'm going to get paid in perpetuity for as long as that note in play. I can stomach that a little bit better, because I know that I'm going to get the benefit of what I did for a long period of time.
That's it.
And that's the thing. If you talk, and I talk to flippers, and I know it's hard because a lot of our volume flippers have teams. So they do need that quick cash to pay their teams. They need that. And I'm like, I'm 49 years old. I just turned 49 a week or two ago. And I'm like, God forbid if I would have kept 25% of the damn houses and just on the paper side of it, like, and I've been blessed and I'm doing just fine. I could pay my bills. But I mean, it would be different. I'd have more money to pay bills. And then then doing it in your model, it's a whole nother ball game that we're not even talking about.
We haven't even.
That's why we're here talking about it, because don't learn from your mistakes. Learn from our mistakes, and I'm not even calling them mistakes. There's better ways to do things, and you figure out a better mousetrap, and you figure out how to get more out of the same or less input and effort, and that's sort of what we're talking about here. It wasn't that. I mean, the first 500 deals that I did, we made plenty of money on. But now, knowing what I know now, I could have made 50% more money
you gave away $300 a month. You gave away $300 a month because you sold the debt rather than keep a portion, which is the $300 a month times 500 deals. I mean, we don't have to be rocket scientists. Pretty nice little thing. And you talked about the millennials. Now, what would a millennial do? I'm telling you, if they understand this at a young age of being able to control this debt and create it, I mean, it's an absolute game changer. Because the cool thing about paper, like, I don't literally need, like you said when we were talking before we got on the call about how the virtual environment is so amazing now, especially with young children. I have children 12 and 14. They're on. I mean, at 3:00 every day, I'm an Uber driver, and I wouldn't change it for the world. And that's why I created this lifestyle, right? Cash flow, right? Is so I can do all that, but I can travel anywhere I want, when I want. And everything is a system. And that's what Nick and I've created, is to create a system around this where it's a phone call, a text, or an email to solve the problem. Because people will be like, well, what happens when they don't pay? What do you do? There's a system for it. There's a process for it. And it's not that big a deal. It's actually a better deal because you can just pay them off and go buy another and go bring on another borrower that's in line for this house.
It's about as passive as you could possibly get. I mean, let's be honest. I mean, anyway, enough of that. We've already beat that.
So how do people go about learning more about like doing this and being the bank and getting into notes and creating paper? Like, what is the path for you guys?
I don't know. They're just going to have to probably Google it, Chris, and see if they can get lucky finding the right people to do stuff with. I don't know.
Yeah. You know, that's what I always say, that thing, but not many people know about Google these days.
It's like my kids. I have two teenagers, and they throw up their hands and wave the white flag about 8 seconds in anything right now. And I said, I don't know, go ask Google and see what they say, because Google knows a lot more than I do anyway. Or if you want to be really in the now, just go to YouTube. That's probably gives you more video of a virtual visual approach.
It's called GTS. Google that shit.
Yeah, exactly. I don't know so we have if they could go to the usanotepro.com. That's our forward-facing site. It's sort of like been, as we grow, it's just easier to integrate it all into there. And there's some ebooks on there that talks about how to be the bank, how to buy and sell mortgage notes. There's a link to our Creative Dealmaker Academy if they want to really, turn this into a business. That's there. They just want to be a passive note buyer and want to just understand what they need to look for from a due diligence perspective, so they don't get burned in buying a note, because that's probably the biggest thing you have to be careful of. That information's there. And if they want to buy and or sell mortgage notes, we're buyers and sellers of that as well. They can access that on that site as well. And then from there, they can reach out to Eric or myself. And we're always doing stuff on social media. We do a weekly deal or no deal segment where we go in and somebody brings us a potential deal and they go, what would you do with it? How would you structure it? Why should I do it this way? Why shouldn't I do it the other way? And we just we deep dive into it and go through that discussion and determine. It's always very funny. We just did one the other day, and it's like,
that's why I was smiling, because it was a wholesaler had no chance of this deal.
Well, and they thought they did. That was the funny part about it. They go, this is exactly what I'm going to do with this deal. I go, okay, well, good luck with that. let's just model this out and see what really is going to happen.
It was a
Why
no
ask Chris
deal.
that question?
It was a no deal, and it turned in. And when we were done, she was going to make $135,000
by just changing one thing in the process.
Oh, did you steal?
I don't know what
that
that's
one
worth.
from my line. No, just kidding. Just change one thing.
Just change one thing, man.
The key to this stuff is one of the things that obviously you can tell we're excited about it because it's what we do. But the structure and the paperwork on how you put all this stuff together, it's pretty simple. But you just got to make sure you structure it. So, like, I mean, I'll just give people like a simple deal. It's like I always have first right of refusal to buy the note that I create that I sell, or if a seller sells me, creates a note for me. And then I always have first right of refusal to buy. I mean, this is like a great tip. I always have first right of refusal to buy the house too that I sell. So I'm in full control, more control than any bank.
I could be in the 19th position on the debt, and it doesn't change the fact that I still control the deal. Honestly.
Yeah.
So, but here's what I want to say, that what Eric was alluding to, is that what we do is not difficult. It's just complex. Okay. There's a lot more moving parts and steps in the process. And I think in general terms, that's why a lot of people don't maybe do it. But what I'll say about this is that all those additional steps that are in that process, it's all outsourced and leveraged, right? I'm not doing any of the stuff myself. We have, to keep it compliant with Dodd-Frank, with everybody goes scared about Dodd-Frank and SAFE Act and all that stuff. So what? You use an RMLO or a residential mortgage loan originator. That's not who I am. That's who gets paid to do the underwriting. Great. Just like you go to a title company to close the deal, just like you use an attorney to draw up the promissory notes or the deeds of trust or whatever it is. Just like we use a third-party servicing company to manage the payments coming in and out, just like you would use a property management company if you're a landlord. So those are all things. So that's the process and systems that Eric's referring to. And all you got to do is just make sure that you complete the 22 steps or whatever it is in the process to get it done. But 90% of that stuff is done by somebody else. 99% of it's done. The only thing that I do in this is I sign documents because I can only sign for myself. I guess I could use a power of attorney. And number two, I like to personally model the deal out. I don't trust that necessarily upon most people. Maybe they do the preliminary modeling and evaluation of the deal, but it takes me literally 7 minutes to put it in a model. And it's pretty idiot proof. It's red, yellow, green. Red is bad.
That's how our deal or don't deal is. We have a spreadsheet and we just kind of go through it. You're a spreadsheet guy.
That's it.
The cool thing, what I always like to tell everyone when I'm on, because I mean, a lot of your tribe, they're real estate people too, right? Mm-hmm. I mean, that's part of the plan. And so all I want people to do is just add this to your toolbox. I mean, if you're fix and flipping, well, what if I did sell this on? We were in Denver. We were in Denver. We took our boys to the All-Star game last week. And so I have a little social media following, but not a ton. I just sent out a little post and says, hey, we're in Denver. We're at the Regency. You guys want to meet up for coffee at 9:00? The game's not till 6. Our kids are going to sleep anyway. Let's get up and just have a little coffee talk at the round table. And sure enough, one of the guys that showed up there, I don't know, we had 10 or 15 people, showed up and he was about ready to flip this house. And then we ended up adding, I don't know what the number was, but he's like, you know what? I know I'm going to sell it at 435, but if I sell it on seller financing and I get the down payment, I'll actually put $40,000 in my pocket and cash flow $1,000 a month. Cause he, I'm going on a tangent here, but the seller was going to sell him the house and let him take over payments at 3%. So he just arbitraged all this stuff. And now all of a sudden he's going to make $1,000 a month for the next however long, let's just say it does go 10 years and put $40,000 net in his pocket. So he's going to triple dip or maybe even quadruple dip on this deal. And he's like, holy crap. Like, why am I not doing this?
The other thing I'll say to that is that it doesn't matter what your investment strategy is, whether you're a fix and flipper, buy and holder, I don't care. The question becomes that I always ask, when plan A fails, what's your plan B on a deal? It's that simple. I'm not here to tell you how to manage or control your plan A. I'm just saying I can be your plan B, or we can be your plan B, or this is how you can use plan B to get more deals done that you're not getting done because it didn't fit the box that you think it needs to fit into. That you got this box this big. I'm telling you, the box needs to be this big. And you play in that perimeter. And that's where a lot of opportunity comes in, because you've already invested the time, energy, and effort to find the seller, to find the deal, or do whatever it is that you do. So why not just look at things a little different, take an extra fight, do plan A. When plan A no longer works, maybe there's a plan B. And that's sort of what we're talking about here. And that's what we try to do, and show how a landlord, hey, when your landlord, when you fail as a landlord, instead of trying to be it again, maybe you go to another plan B. That's it.
Yep. So folks, if you're looking at this and thinking, wow, that sounds, complicated and that, just remember what Thomas Edison said. He said, opportunity is missed by most because it's dressed in overalls and it looks like work. Don't be the one that misses out on the opportunities, because honestly, this is a massive opportunity. And, you're probably just thinking, well, I don't know this. Well, learn, take action. Just like I said earlier, you want to do something, don't just get knowledge. You just got knowledge for an hour. Now take action on this knowledge. So, we're going to put it up in the show notes, but it's usanotepro.com. Sign up for their newsletter, get around the campfire, start learning about how you can do this. Stop making excuses. My God, everybody's got an excuse for why they don't do something. And that excuse is what keeps you exactly where you're at in your life. And not only that, the people you surround yourself that want you to conform to their ideologies keep you there. Stop it. Start being the bank, learn something new, and stop the bitching and get on with your life so that you can be free, be in control, and have that income to live your perfect day every day. So, gentlemen, this has been awesome. One final question for both of you, and I'm gonna mix it up. So, Nick, I'm gonna start with you. What has been your biggest external obstacle in this journey?
That's a great question. I think it's probably goes back to limiting beliefs on what I think I can do versus what I probably can do. I mean, Eric does a very good job of saying, you know more than anybody else that I know. And I probably don't believe that as much as I probably should. And I think that's probably the biggest obstacle that I would say for me is that, what I have and what I know is something that I think is of extreme value. But I don't always put that in the proper perspective.
Oh, that's good. And then Eric, one for you. What has been your biggest internal obstacle that you've had to face?
Ooh, internal. Ooh, that's a good one. For me, I tend to want to do everything. Versus I know my unique ability. And my wife has been my business partner since we've been married 17 years. She's been my business partner before we got married. And so Dan Sullivan, right? So I know what my unique ability is. I love sharing this story, and I love bringing people in, and I love teaching it, and then I hire everybody else around me, and internally, and this is what I tell a lot of people. Okay, not everybody loves to analyze deals. Not everybody loves to spreadsheet things out. I'm one of them. I look at a spreadsheet, I get a little weirded out, but there are people that do love that. Okay. So you can plug my wife was a perfect example. She's the rainmaker. When we started business, she knew I wasn't going to create and do the websites. I wasn't going to create the landing pages. I wasn't going to set up the marketing. I wasn't going to do all that. But when a lead came in, I would close that lead and try and solve the problem for that seller or homeowner or whatever. And so what I would always tell people is find out what your unique ability is. And this goes to like high school kids that are just learning, like, oh, what do you want to be? What do you want to do in life? Well, find out who you are as a person and then plug yourself into that and be great at it. And then hire out or partner, which, having business partners are good and bad. But once you find out who you are as a person and what you're great at, just become really good at it and bring on the best people around you to support you. But don't hire, I've done this, don't hire your twin. First of all, and hire, like I hired a buddy of mine. Well, he and I were the same. Well, how are we going to be good if we're doing the same thing, for our business? And so what I found is just find what you're great at and be really good at, and then put yourself around the people to support you.
Love it. The old Henry Ford, hire your weaknesses. So folks and gentlemen, thank you so very much for joining us today for the Real Estate Money School. Everybody listen up. Remember earlier, I challenged you. You wanted the free booklet. Okay. Drifting away from traditional car buying. It takes action. Go to chrisnoggle.com and click on the wealth webinar, which is free. And we will send you that. And if you're really an action taker, actually join us for the wealth webinar and go to usanotepro.com and check out what these two brilliant gentlemen are doing with Being the Bank. For that, we'll see everybody on the next episode. Have a good day.